All right. Today is Sunday, the 15th of September. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. And we have a lot to talk about tonight, folks. From the second hit on Trump, got a new one today. And then, of course, the twists and turns that we got in the market this week. And by the way, the twists and turns that we're going to get again in this upcoming week. But of course, the top question in mind right now is ugly September over? Since we got a rebound this week, do we have the all clear? Are we out of the woods now? And the short answer is no, because we know that the seasonality is not pretty good. If you look at September, the average performance is negative for the Dow Jones, the S&P, the Nasdaq, the Russell. And if you look at specifically in the past 5 years, September been uglier than it's ever been before. And of course, you can attribute that to perhaps algorithmic trading. It looks at the seasonality and exacerbates the moves. So you see July, for example, hotter than ever before. November, same thing. But September happens to be uglier than before because of the algorithms. And we know that the ugliness of September usually shows itself in the second half of the month after the FOMC meeting, not before. So what you've seen in the first week of September, that could be just the appetizer. And now we have a rebound and everybody thinks that, okay, we got the all clear and the worst is behind us. And next thing you know, it gets ugly again. So you gotta be really, really careful because the twists and turns will be absolutely stunning. I mean, look at what happened in the last 2 weeks alone. And this is gonna continue to happen all the way till the FOMC because all the way to that point, the market is subject to expectations. And whether the Fed is gonna do rate cuts and how much, 25, 50, more or less, for the good reason, for the bad reason. And you're not gonna see some sort of stability, be it in an uptrend or a downtrend, until the meeting and the decision is out of the way. And this is why I released this video publicly. Hope you caught it over the weekend. And this is from last Wednesday. We talked about the CPI data at that point and the reversal that we've seen during that session, where the shorts decided to cover for whatever reason. Doesn't matter what it is. But we've seen short covering happening by professional traders who, let's say, shorted before the beginning of the month. They decided that Wednesday, September 11th, was the day to book profits and wait in the sidelines, perhaps, for a rebound to ensue, and then short again during the week of the FOMC meeting. But I have to clarify one thing because some viewers got mad at me, accusing me of flipping from bearish to bullish this week. No, you stupid bitch. That's not what happened. We told you that we're gonna have twists and turns, and trading all the way till the FOMC will be absolutely jittery. So we have to establish guidelines on the charts and follow them verbatim. It ain't about bearish or bullish. Everybody knows that we have a bearish outlook on the economy, and it begins to take shape right after the cuts. And recently, we've added both longs and shorts to the portfolio with great success, because there is stuff that you can still pick in a change in interest rate regime, but there is other stuff that will fade away. Yet when it comes to options trading, two things are really important, and this is what we're talking about here. We flipped midweek from one side of the bet to the other. When it comes to options trading, number one, time really matters. And if you're on the wrong side of the trade and the time continues to pass by, you will be subject of decay. By the time the trade goes your way finally, you're already deep in the hole, you're not going to be in profits. It's going to be a chase of let's reduce loss at this point, number one. Number two, in options trading, you're subject to the implied volatility. And if you're holding short positions, aka put options, and there is risk, as we witnessed on Wednesday's session, if there is risk of the VIX falling down from, let's say, a danger zone such as above 20, and it falls down to 18, 17, 16, that's going to cause a lot of decay in your put options from the perspective of the reduction of implied volatility alone. So you got to be surgical when you're trading options, and that's all what we've done. For example, look at the SPY. We enter the week, and we gave you many guidelines on the Nasdaq futures, which we attached in the video that I just pointed out. But on the SPY, for example, 550 is the bear to bull advantage line. Trading below, the bears got the advantage, downside has better odds. You're trading above, bulls have the advantage, upside has the better odds. So we began the week trading below 550. And as I'm highlighting right now, all the way till early on Wednesday, the risk was still to the downside so long as we're trading below 550 and the VIX is still above 20. But then something midday changed, and we've seen the VIX dropping down, closing below 20, and we've seen high volume showing up in the market in buying specifically the most shorted names for the week or for the month, such as Nvidia. And the conclusion right off the gate was that the shorts are covering for whatever reason, doesn't matter what it is. But we got a technical confirmation of reversal when it comes to the odds and the risk. The upside is now more predominant than the downside. But we gave you exactly how we're going to play it, which trades were closing, which trades were opening, step by step. And guess what? Since Wednesday's session, the S&P 500 moved higher by a little over 1.25 percentage points. So again, it's quite baffling that some viewers, I don't know what they really want. So I apologize to them for being on the right side of the trade this week. Maybe I'm going to try to do a better job next week by making sure you're going to be on the wrong side of the trade. I'll try to do my best here. What a bunch of silly, stupid But anyways, all joking aside here, folks, we're going to have another twist in the market this upcoming week. Why? Because on Friday's session, see all the way till Thursday, the assumption was we're going to have 25 basis points cuts, and that's it. And you've seen the big caps moving higher. You've seen the sectors banking on 50 basis points like the IWM or the regional banks actually underperforming. But then came Friday's session and the market behaved as if we have 50 basis points coming in the upcoming FOMC meeting, not 25. And that's a huge assumption. And this assumption will be tested. And based on the outcome, whether this assumption is verified or not, we will see a major twist this week. So let's begin right off the gate here with the wall of hope. And we start with the easy one, the AI mania. The question is, was it a good week for the AI mania or a bad week as we've seen the first week of September? I would say net positive for the AI mania, although we got some stuff that we need to talk about when it comes to the policy risk, because it seems that both parties are hawkish against China and specifically exporting AI chips to China. So that's the negative. But the positive was an assurance coming from Oracle. And again, whether the results were good or bad doesn't matter. What matters is they gave more hope for the AI mania. We've seen Oracle, the stock moving higher since the close of last week to the highs of this week by over 22%. By the way, making Larry Ellison, the founder of Oracle, as the second richest man on the planet, right behind Elon Musk, surpassing Jeff Bezos. But of course, anybody knows Larry Ellison, you know that he's a major dumper. He's not going to let a pop like this go without dumping at least $5 billion in shares. Liquid cash, baby. You enjoy the paper gains, the oligarchy enjoy the liquid ones. But the bottom line is, if you look at the RGV, the software index, where Oracle is, of course, and we said before that at this stage of the AI mania, we favor software over chips. The chips will have problems with the export restrictions, with the supply issues, with pricing issues. On the other hand, you look at the software AI implementation of efficiency. It's easier to be done and show results if you're a software company, results of the AI hype, of course, than non-software companies. So I think right now, as I said before, there's a migration in the AI mania from chips to software. And right now, you look at the weekly chart for the IGV, looks maybe like a cup and handle, looks from the momentum indicator that we're maybe going to break higher. And perhaps the news from Oracle will bring more money into software. On the other hand, you look at the SMH, this is the chip index. It doesn't look as good as the IGV. It looks maybe toppy, as showing a head and shoulder pattern, ready to go down. And the other thing is, companies, of course, continue to cite AI in every freaking earnings. But it stopped doing a lot of magic for many companies. As if right now, in this stage of the mania, the market says, show me the money. And if you're just saying AI, you're not showing the money, you ain't getting rewarded. But if you say AI and you show results, or you promise results, you're getting rewarded by the market, case in point Oracle. So again, software becomes an easier bet than chips. Now we go back to the wall of hope because the most important element is rate cuts optimism or more rate cuts optimism depending on the week and the mood of the market based on the data. So let's go back to the question from the beginning of the show. Why did we see the narrative change on Friday? Well, we have an assumption now, a base assumption in the market of 50 basis points coming by the Fed this upcoming week, not 25, because heading into Friday, we got the CPI out of the way, came in line with a slight hotter reading in the core CPI. So that's not going to merit 50, that's going to merit 25. And immediately after the CPI, you've seen the odds of 50 basis points plummeting and odds of 25 going higher, becoming the majority, the consensus of the market. But then comes Friday's session and it's neck and neck. It's 50-50 that we could get either 25 or 50 basis points. And that's why the market was really happy on Friday's session, because we've seen a revival of 50 basis points rate cut optimism. Well, gee, how did that happen? Maybe we got a piece of data on Friday that justifies the increase of the odds of 50 basis points comes this Wednesday. Not really. We got the UMISH Consumer Sentiment Index came as a beat, and inflation expectations for 5 to 10 years were actually slightly hotter. The expectations were 3%, we got 3.1%. So again, there was no reason whatsoever from the macro data to go with the 50 basis points assumption versus the 25, which was the consensus all the way till Friday. Except, of course, the rumors that we got from the Wall Street Journal, courtesy of Nicky Boy, the Fed's favorite, who issued this article right here. I have the shot from the actual paper because the Wall Street Journal, they have the tendency of changing the headlines that they post online. But in the paper, you can't do that. What's already printed is already here. And this is the rumor that Nick Timiraos floated on Friday's morning. And the headline reads, size of the Fed's expected rate cut remains close, called before the vote. And he suggested that the 50 is still on the table. The Fed didn't really eliminate 50. Of course, the headline on the website changes to the Fed rate cuts dilemma. Start big or small. That wasn't the original headline, Nick. You guys changed the headline because maybe whoever wanted you to float that rumor on Friday, because they got some call options, they got to make some money out of them. They're done with that right now. And you got to take that headline back because nobody rational really believes that the Fed will do 50 basis points unless something else happens this week. More on that in a minute. But you know what I want to talk about right now? I want to talk about folks who say, oh, Nicky Boy got the best sources in the Fed. He's the Fed whisperer. Whatever he says means that that's what the Fed is going to do. Bullshit. The Fed is a whorehouse, right? The Fed gets bought and sold for the highest bidder. You got a price on every zombie in the Fed. You want Atlanta zombie, you get 50 grand. You want the zombie from New York? That's 250 grand because he has more power. You look at the news that we got this week from Atlanta Fed zombie Bostic, who got caught doing insider trading again, violating the rules. And of course, every time we see one of these zombies from the Fed, corruption per usual, of course, doing insider trading, it is a culture in the Fed. Insider trading, that is. And every time they get caught, they come out and say, you know what, we've investigated ourselves and we found ourselves not guilty. Now, if you want to do a real investigation, it'd be an independent watchdog, not a watchdog from the Fed investigating the Fed's corruption. Doesn't work that way. But if Atlanta Fed zombie Bostic is willing to break the rules and do insider trading to make 50 grand, you think he's not going to sell his soul for 50 grand if I hand him an envelope with 50 grand in cash? You think Bostic is not going to take the envelope? You think Bostic is not going to feed me insider information from the Fed on how to trade? Now think about what is the price on J. Powell. Maybe a little higher, maybe in the millions. A little out of reach for yours truly right here. But again, do we think that these people have any integrity at all? You think J. Powell is not leaking data to his buddies in Wall Street, the banksters? Oh, we're going to do 50, we're going to do 25. You think he's not doing that and banking millions and millions of dollars? Think again, buddy. These people have no soul. And maybe Nicky Boy is getting some favoritism treatment by the Fed because he's just being obedient. He's not questioning the Fed and he's just saying whatever they want him to say. Maybe Nicky Boy at some point needs to do an article, an investigation, actual journalism on the Fed's corruption. Because it's been years right now of a series of insider traders in the Fed, and nobody was held responsible. Every time we have a scandal, either these Fed zombies say we investigated ourselves and we found ourselves not guilty, in the case of Bostic and J. Powell, or if it's really bad and they can't hide it, they just resign. Oh, we're going to retire early. And case in point, of course, from Boston, zombie Rosengren, and then the former zombie from Dallas, Kaplan, both of them got caught. And then what do they do after they graduate from the Fed? They take jobs with the banksters, with Wall Street. So do we really think that they weren't feeding information to these same folks when they were in power in the Fed? I mean, you got Kaplan now, he works as a VP in Goldman Sachs. Don't forget about VP of the Fed, Clarita. Got caught doing insider trading, says he's going to resign. Sure, okay, we're going to resign. Takes a job at PIMCO as a global economic advisor. Maybe PIMCO is just paying him back for all of the leaks that he's done before. This is a culture of corruption. And I'd love to see Timiraos and the Wall Street Journal actually doing real journalism and investigating the Fed. But they're never going to do that because it's all about access. It's all about corruption. Anyhow, let's go back to the market here. When we go to the battle of the cakes, of course, the market wants both options open. But in certain weeks, you're going to get the data really, really bad where cake number one disappears because we get recessionary data. And there is no doubt that the risk of recession is looming large. But at the same time, we cannot eliminate this cake entirely because you're going to still get more and more cooked data before the elections. GDP, retail sales, and other payrolls, CPI. So you cannot really eliminate cake number one. But we know it's going to disappear. And this week we got some really stunning recession data and economic warnings. Think about the warning that we got from Ally Capital, or Ally, whatever you want to call it, doesn't matter to me. But the stock crashed this week. And they warned about consumers right here. The headline, consumers are struggling to pay back car loans. Look, we talked about this issue in details before in the show, that we're seeing credit card loans, auto loans, delinquency rates moving higher, now on par with the period before the Great Recession in 08-09. So that's a huge risk that you cannot really eliminate. And the consumer, of course, always engages in bad behavior. They take loans and they take debt that they cannot really afford to pay back. And now they're stuck with these auto loans at higher rates. I mean, you guys see the memes online, right? When you go to the auto dealer and you sign the paper for the loan, and they can't believe that you signed for an insane interest rate in the loan. But folks don't really care. They think that they're going to pay it back. Their jobs are in the bag. The moment you introduce just a little bit of weakness, a little bit of layoffs, you begin to see these delinquency rates moving significantly higher. So again, the warning from Ally or Ally is nothing new, really. It was the consensus. But if you shorted Ally Capital stock all the way to this point, it wasn't rewarding because they were talking about soft landing. Oh, the Fed is going to cut rates. Everything is going to disappear. Any problem that we have going to disappear. Now we know rate cuts or no rate cuts. It doesn't really matter. You're not going to be able to eliminate these kind of risks because you cut rates by 25 basis points, 50 basis points. Would that really help the folks who are going delinquent on their auto loans right now? Of course not. So we finally see these consumer lending companies breaking down. And it was an ugly, ugly week for these kind of stocks. Now we go back to the cakes. So we've eliminated cake number one, at least for now, for this week. No rate cuts because there is no recession. Well, we got really horrific data indicating that recession is a real possibility from Ally Capital. So now the hope becomes cake number two. If there is a recession, I want to know that the Fed will cut rates aggressively, not 25, but 50, maybe more, right off the gate. And on Friday's session, the market decided to play that game of cake number two. Why? What is the reason? Because right now, this is a major assumption heading into retail sales data this upcoming Tuesday. When I say prepare for the twists and turns coming out this week, you got to understand this. Now that we have the assumption of 50 basis points, not 25 basis points, I know it's neck and neck if you look at the FOMC tool, but then look at the market's pricing on Friday. The IWM, for example, the small caps, pricing in 50. They're not going to thrive under 25. That's not enough. They want 50. They were kind of disappointed. Wednesday, the IWM was actually negative. Thursday was the underperformer. Friday, small caps were the outperformer, as we've seen the odds of 50 basis points going higher. So the market tells me right away in Friday's session that the odds are actually, that's what the market is pricing, whether that's going to be met with reality or not. But the market is definitely pricing in 50 more than 25 basis points when the FOMC makes the decision this upcoming Wednesday. Now, the caveat, of course, is retail sales. That's going to come out Tuesday. And the outcome of retail sales will introduce another twist right before the FOMC decision. So suppose that retail sales come out ugly. Say the government cooks forgot to cook the data. Then we're going to get the 50 basis points, but this time it's going to be for the wrong reasons. I mean, think about it this way. If we get an ugly retail sales data, on top of the data that we got this week from the banks and consumer lending companies, that we're beginning to see delinquency rates actually exceeding expectations. You add them all together, the market would now look for 75, not 50. So 50 will be a disappointment because now we're doing 50 for the wrong reasons. Now, suppose the retail sales number comes out hot and Powell comes out the next day and says, you know what, I don't see a reason for 50, I'm going to do 25. We'll take it one step at a time. You think the market will be happy or upset. Now that it already priced in 50 basis points, not 25, I think it's going to be upset. So that's not a good scenario. The only positive/bullish scenario that I see for this week is if we anticipate 50 basis points, retail sales come out hot, meriting 25, not 50. But the Federal Reserve decides to go with 50 anyways. Under this scenario, I see the market happy, and I see a big rotation into the big caps, the regional banks. We can talk about that in a minute. But what is the risk if the Fed indeed does the 50 basis points while we have hot retail sales data, while we still have the unemployment rate down, while we still have inflation in the housing market, prices at all-time high? We know from the case of 2007, 2008 that when you begin to cut rates as the Federal Reserve, we just gave you the example of you're delinquent in your auto loan. If the Fed reduces rates by 25 basis points, would that really do anything to you to help you out in your loan with the fixed term already? Not really. So until you see a positive impact of rate cuts in the economy, you got to wait at least a year. But the feedback of rate cuts can be felt and seen immediately when it comes to mortgage rates, when it comes to commodities inflation. Meaning there is huge risk that we cannot really ignore, that once the Fed begins cutting rates, we will see the revival of inflation. Let's go back to the CPI report that we got this week. Of course, nobody in the media wants to talk about supercore CPI, which is a leading indicator to where our CPI is going to go later on. And this month's reading was hotter than the previous month, meaning we see supercore moving higher. What do you think will happen when the Fed begins cutting rates? I think you'll see inflation coming back, but the economic recovery taking a longer time and requiring more rate cuts before you see any impact on that side, which could exacerbate the stagflation phenomenon that we have in this economy. And of course, this leads us to the warning that we got from JPMorgan's boss, Jamie Dimon, who warns the U.S. of economic fate worse than a recession, the worst outcome. What is Dimon talking about? Here it is. JPMorgan Chase CEO has laid out the worst outcome for America's economic future beyond recession. The worst outcome is stagflation, said Dimon, and by the way, I wouldn't take it off the table. The 68-year-old Jamie Dimon made his remark on Tuesday at the Council of Institutional Investors in New York. Now listen to this. Interest payments due in October on the national debt now exceed the cost of both Medicare and national defense budget. National debt may contribute to further inflation on the horizon. This is the first time in American history that interest payments on the national debt have risen above $1 trillion. So it is hard to look at it and say, well, no, we're out of the woods. I don't think so, said Jamie Dimon. Now look, you can say whatever you want about Jamie, but he was right when he warned about a recession in the year 2007. He warned. Nobody wanted to listen. And then fast forward, about a year and a half later, we got a market crash and a recession. Jamie Dimon warned of a recession while Bernanke, former Fed chair, was still clueless. Listen to this. In January of 2007, Jamie Dimon warned that an uptick in mortgage defaults might indicate that a recession was coming. And now we see not mortgage delinquencies, at least not yet, going higher, but we see delinquencies in credit cards and auto loans going higher. You gotta be careful. You cannot eliminate the stagflation risk. I mean, look at what's going on here. Payroll growth, all the way till the Fed first rate cut and then after. You can see that we have two examples, what they call the soft landings, these morons, in 1995 and 2019. But we have worst outcomes, recession outcomes, where payrolls went down after the rate cuts in the cases of September 2007 and Jan 2001. Now, are we similar to 2019-95 or 07-01? I think the answer is clear. In the case of 2019, the Fed was raising rates when there was no inflation problem. So the market threw a fit, and we've seen some companies doing layoffs in anticipation of the Fed tightening the rates, and then the Fed backed off, got scared with the market going down 20%, and there is no inflation risk. So they began cutting rates. And in the case of 1995, we talked about this in details before. The economy here, domestically, was pretty good, but the Fed was still traumatized from the episodes they got in the 70s when they missed out on catching inflation, and it got out of hand. So they acted aggressively in the case of the early 90s. And the majority of the weakness that we got is not in the domestic economy, but was in the currency market, the tequila crisis in Mexico, and later on the Russian ruble crisis. On the other hand, you look at the 07 and 01. In the case of 01, we're exiting a tech bubble. As we have right now, in 07, we're cutting rates because we see weakening in the economy, but we have an inflation episode. We're closer to 07, 01, which means that after the cuts, we might actually see the payrolls going down, or we begin to lose jobs in the economy. On the other hand, you got to remember, if the Fed does 50 basis points cuts, look at the comparison here of the 12-month inflation rate in 24, heading into the rate cut, the first rate cut. We're way above the inflation rate in 07. We're way above the inflation rate in 01, 95, 2019, which means you cut the rates, you might see a revival of inflation while we see the economy payrolls weakening, and hence the stagflation problem that Jamie Dimon is warning about. Now let's segue to the wall of worry because we have a lot of stuff that we need to talk about. We begin with the policy risk, and the only risk that I see from this week is what we got from the debate. It appears that both parties, Democrats, Republicans, going to be hawks against China. And now with the odds favoring Harris to be president, you got to remember that moment in the debate when she accused Trump of being, he basically sold us out to China. She was pointing out that he allowed the exports of chips, AI chips to China, suggesting that perhaps the Harris administration will impose more restrictions on exporting AI chips and AI technology to China. Well, that's not going to bode pretty good for the chip companies and the AI mania that we have in the stock market because China growth is really important. And up till now, NVIDIA have been losing loopholes like using the CoreWeave scam to buy chips from their own company and then sell them to China, or using some shady crypto companies in Singapore, and that's of course a cover for exporting the chips to China. But it appears that maybe the Harris administration will be tougher in closing these loopholes. That is the case. Do we think that the AI mania continues to go? Would you take out the growth element from China? Then we go back to the wall of worry. Let's talk about the election risk. And look, we got the debate out of the way, and I told you after the debate, we're going to get a clear picture on who's going to win the elections. Now, we talked about this the moment the debate was out of the way, the same night, and I said that Harris won the debate. I don't think that Trump did awful, as the media was suggesting, but he was way off. Easy shots that he didn't take. He was baited so easily. He sounded so annoying and just so into his head. And it was a turnoff for a lot of folks watching the debate. Now, prior to the debate, Harris was leading by about, let's say, 1 to 2 points. After the debate, the gap now widened to about, let's say, 4 to 5 points. If you're opening a gap of about 5 points in the middle of September, there's not enough time to close the gap. I think the election's in the bag. I think maybe Trump can close the gap back to 3, 2, but at the end of the day, right now, I think the odds favor Harris overwhelmingly, of course. Absent of an economic crash or market crash and a big deterioration of the economy between now and November, I think Harris got it. The elections are over. And then today he comes out and he says he hates Taylor Swift. I mean, who's running this campaign? It's not that I got a lot of love for Taylor. She's just another privileged, out-of-touch celebrity. She owns all of these mansions across the country. She's not facing anything relating to housing affordability like regular folks. So it doesn't matter to me who she endorses. I think everybody sees her as an out-of-touch elite. But you go as far as saying you hate Taylor Swift with capital letters? That's a loser move. You don't want to do that. But is there any hope left for the Trump campaign to come back? Maybe. They took another shot at him today. The first shot, he couldn't really do anything with it. He wasn't smart enough to milk that thing for all it's worth. Because if it was the other way, somebody took a shot at Harris or Biden, or the Democrats will this is the radical MAGA movement responsible for an assassination attempt, yada, yada, yada. He never did any of that. And again, politics is a game. It's a vicious game. Either you play it right or, you show up to the debate unprepared. Sorry, you deserve to lose. Democrats know how to play the game better. Whoever plays the game better deserves to win. Frankly speaking, my preference is Harris because I want the Democrats to assume the economic mess that they got us in. I don't want them to have the easy way out and just, the economy crashed because you guys voted for Trump. I want them to assume the responsibility for what they've done all these years. With that being said, can Trump come back because of this hit that we got today? I think so, but he got to do one thing, and one thing only. If anybody from the Trump campaign listening, this is your only hope left. You got to take the debate. You can't say I'm not going to take another debate. You got to take another one to fix the mess that you've done this week. And in the next debate, he got to point to Harris and do the Denzel Washington thing and say they tried to take a hit on my life and then pound the chest.
They tried to kill my wife.
And after that, got to do the lip quivering thing that he does.
I'll grab your hand and you play me.
Yeah.
Hey,
you get your fucking hands off me.
So again, last hope. You got to go to that stage and point at Harris and say, they try to take a hit on my life. Chest pound, lip shake, boom, you're the president again. Otherwise, forget about it. The elections are over. Harris will be the next president. And by the way, don't forget that for folks who say that ugly September is over and all of that, you got to remember that heading into the elections, we actually see a downturn in the market. You want to talk about seasonality and algos and all of that, we actually see quite a shaky period, speaking of the lips, all the way till the elections. Then after the elections, when we get the certainty, the market does better. So we still have a lot of election risk, and folks should not dismiss that. Now we go back to the wall of worry. What about the geopolitics? Do we have any risks coming out this week? Who knows? We have the Middle East front right now. We got a Yemen Houthi strike on Israel. And now the Israelis are vowing heavy price for the Houthis. Is it going to escalate into a full war? Will we see more attacks on ships in the Red Sea? I mean, that's an open front, and I think we'll see more escalation be it in the northern front with Lebanon or the southern front now with Yemen. It's a mess. And I think that more escalation is on the way. Now, I think the Russia-Ukraine front is more dangerous at the moment because we're talking about a new package that we're preparing for Ukraine. Billions and billions of dollars. You're getting delinquent, you're losing your car and your home, but your taxpayer money is still good for war overseas. And they say that with the package will come the permission from the United States and NATO for Ukraine to use long-range missiles in attacking Russia deep. And of course, President Putin of Russia said if that happens, it's going to be the equivalent of Russia being at war with NATO and all of the European countries and the US. Now, of course, they would dismiss this as, oh, he's just bluffing, even though Medvedev, the other Russian president, said that he threatens to turn Kiev into a giant melted spot. In other words, threatening nuclear weapons. And like I said before, they're going to keep poking and testing the limits over and over again until Russia snaps and uses a nuclear device against Ukraine. And then, of course, if that happens, it's an open end. What happens? World War III? More nuclear attacks and testing? Who knows? Now, would that risk happen before the elections, after the elections? Frankly speaking, doesn't matter. What matters is it's going to happen. And I don't see any rationality taking over miraculously at some point. Now, what would that do to oil? Because a lot of folks would say, what does it matter, Maverick? If we have geopolitical risk or not, if oil continues to get crushed. You got to understand one thing. Oil right now is reacting to the recession news. Oil right now is the one pricing in a recession. But oil will find a source of relief once the Fed begins cutting rates. Because it doesn't matter, 25, 50. If you cut rates, you initiate short covering in oil, which is over-shorted right now. They're all piling in on the same trade. You introduce the Fed rate cuts, you initiate short covering. And of course, on top of that, if you introduce any geopolitical risk, an escalation, then all of a sudden oil changes from becoming the most hated asset to the most loved. And we see more and more short covering. We see a big pop in the price of oil. So right now it looks weak because it is pricing in a recession. But be careful, things could change the moment we have a rate cut because other elements are still supportive of oil prices going higher. Now we go back to the wall of worry. What about China? Any risk that we got in this week regarding China? We talked about the weakness in the Chinese economy and the impact on the global economy in details in last weekend's video. The only update that we got this week actually came Friday, and the headline reads, Biden targets Shein, Temu, these are the cheap Chinese retailers, with new rules to curb alleged abuse of U.S. trade loopholes. Basically, you have a lot of Americans facing inflation, let's say poorer consumers, lower income consumers, and they can't really shop at the store because it's so expensive. So they're shopping at these Chinese retailers, Temu, Shein, doesn't matter which one. Shitty quality stuff, but that's what you can afford in this economy. They're getting this stuff being shipped from China really cheap because it's under $800 per item. And for that, they're not paying taxes. Now the Biden administration wants to close this loophole and make sure they're going to pay more, even if you're using Temu or Shein. And obviously, the stock of Pinduoduo went down right away. And you got to understand that Temu, Pinduoduo, the parent company, is the biggest advertiser in a company that's really important here in this stock market in the United States called Meta and Google. So if you weaken that company, Pinduoduo, wouldn't that weaken the ad spending on platforms like Meta and Google? Something to think about. But it's also an illustration of the hawkishness by the Biden or the Harris administration, doesn't matter, against China. That's something that we have to price in. I mean, even if Trump wins He's not really that dovish on China. We go back to the wall of worry. What about the no deal, the Jerome Powell no deal thing? You gotta understand this. We just talked about it. The market right now pricing in 50. What if retail sales come out hot or not weak enough for JP to do the 50? And he says, you know what, I'm doing 25, taking it easy, one step at a time. I think the market will be upset. So that's something you got to keep in mind. The other element, the last one, is the BOJ. What's going on with the carry trade from the Japanese yen? We're now trading above, if you look at the JPY USD, we're trading above the highs from the month of August where we've seen the scare. Of course, between now and then, we've seen some folks covering their shorts already and going long the Japanese yen. So the level of pain increases. And nobody knows where it is exactly. But so long as we're moving higher in the Japanese yen and the dollar keeps going down, the risk of margin calls in the big cap technology stocks here in the US to cover for the carry trade is highly likely. But we cannot eliminate that. You look at many strategists, including Morgan Stanley this week. They suggested that the August mayhem is not over. It could come back with a large unwind trade. And by the way, UBS also warned about the same thing. There's a large unwind trade coming, and the Japanese yen could be the trigger. Don't forget, of course, we have other carry-on trades. The Swiss franc, the Chinese yen. So it ain't over yet. Ugly September is not over until it's over. End of the month. Then we have to talk about seasonality in October, but one step at a time. Let's talk about the market strategy because a lot of things changed between last weekend's video throughout the week all the way to this point. We've updated our strategy, so we have the long strategy in the SPYV value stock. Doesn't matter which ETF you buy, which individual stock you buy. It's value stocks, mid-cap value like the IWS, dividend-paying stocks, risk-off rotation. Let's identify these a little more because a lot of viewers say, what is a risk-off rotation? And think about utilities, think about real estate, think about gold, think about the defense contractors. All of these are risk-off segments. And folks, these are the new big caps because if you have rate cuts, these are the guys that are going to continue to perform reliably. The problem is when they rallied too much and priced in a 50 basis points cuts. They pulled back the moment we priced in 25 after the CPI came out. So the strategy for these, and you can see that gold is outperforming the S&P. You can see for September, these risk-off segments like real estate, utilities, staples, outperforming the S&P. So the strategy right now in this category, hold and hedge. We stay long because they're reliable in the phase of interest rate cuts. But we're going to hedge because if we priced in 50, we get 25, they might pull back a bit. Now, what about the rent category? And again, we talked about oil, copper, and other metals. Doesn't matter which one you look at. They all act and react the same way. IWM small caps, KRE, risk-on rotation. What do we mean by risk-on rotation? We mean the profitless companies, the high beta companies, the overshorted companies. All of these biotech companies, by the way, they all need lower interest rates, the lower the better, to thrive and eliminate a lot of risks. And by the way, when we talk about risk-on rotation, you got to remember some real estate is included in that segment. We're talking about the commercial real estate, the office REITs, the medical properties. Those did pretty good Friday, not Wednesday, not Thursday. And it adds to the evidence that on Friday, the market began pricing in 50, not 25 basis points. And of course, we have cyclicals. It depends on which cyclical you buy. The airliners have been doing pretty good. The trucks come and go. The hotels come and go. The travel stuff other than airlines come and go. The casinos, for example. The stores come and go. So I say in this category, you got to pick. So for me, I would look at these categories and say, are they pricing in? Or a better question yet, do they need 50 basis points or would 25 be good enough? And I think that the IWM small caps, KRE, the risk-on rotation, they require 50 basis points, if not more. As to oil, copper, metals, the grains, and you've seen that those been performing Wednesday, Thursday, Friday. They've been doing pretty good, regardless of 25 or 50 expectations. So to me, those are more reliable. And of course, some of these cyclicals, not all of them, but some of them, only need 25 to begin to see some light at the end of the tunnel, not 50. But you got to look at each individual stock. And again, on Friday, it was more of the light at the end of the tunnel category. It was more of the dash for trash that we talked about before. Whether that's going to last or not this upcoming week, I think it's going to be short-lived. Unless we have the scenario of retail sales coming out hot and the Fed does 50 either way. Absent of that, if you get retail sales weak, then the 50 will not be enough. If we come out with retail sales strong, and JP says we're doing 25, not 50, I think a lot of them will pull back. KRE, IWM at least, will pull back. What about the sell/short category in the big caps and chips? I say rent. We've done some short-term rentals on Microsoft and the SMH. We closed those on Friday already. So you gotta pick. You might look at NVIDIA and not like it. Went a little too high too fast in a short amount of time because of short covering. Meanwhile, Google is still beaten, bruised, the laggard. Maybe it has more flows coming. So you gotta pick here in your rentals. Which one do you like? Maybe it makes sense to rent the chips for a little bit or some of the big caps for a little bit. But keep your eyes open. I'm gonna give you the guidelines midweek. If we have any confirmation of switching from bullish to bearish again on the charts, the strategy will change and your bets, your option bets will change too. And I think we will see a turn. I'll point it out to you exactly when I see it because be it retail sales, be it the FOMC, if we're running into these meetings and these events with pricing in rate cuts of 50 basis points right off the gate, I think there's a lot of risk for disappointment. Now, the last sector I want to talk about is financials, because I'm going to look at this and say, what about financials? What do we do with those? Are they dividend-paying stocks? Are they safety, risk on, risk off? The truth is financials really hard to pin under one category. And what I would say right now, JPMorgan for sure is falling out of favor. Because JPMorgan was thriving under higher rates. They had the best net interest income. If you take that tailwind away by cutting rates, then JPMorgan will be sold. And it has the highest weighting in the XLF and other financial ETFs. So I say if you've been holding those in your portfolio, it's time to take them off. If we have rate cuts for the good reasons, 50 basis points, and by the way, retail sales pretty good. The only positive scenario I see from this upcoming week. If we have that, then you'll see more of the risk-on categories within financials doing a lot better. You'll see a rotation out of JPM into the regional banks because we're going to have the dash for trash / the light at the end of the tunnel period. But again, if you see the regional banks rallying all the way till the meeting or till retail sales, can you really trust it without these two events coming out aligning exactly as the market assumptions on Friday and perhaps Monday the open would be? And this is why I say in the rent category, you gotta pick. Anything that's pricing in 50, not my favorite until we get confirmation that we're getting the 50 for the good reasons. So I'm gonna stick with the stuff that thrives under 25. We don't need the 50. That's gonna be more in the metals, the resources, the fertilizers, the commodities side. Some of the cyclicals, of course, we can talk about that in details when we get there. But for now, let's add more color to this conversation, beginning with a revisit to the closing of the indices on Friday. And here we go. The diamonds closing in the green by 297.01 points or a gain of 0.72%. And the Nasdaq not the leader anymore, because now we're doing 50, not 25, up by 114.30 points or a gain of 0.65%. The S&P also in the green. 30.26 points to the upside or a gain of 0.54%. But the winner of the day is none other than Mr. 50 basis points cuts or more. The Russell 2000 up by 5.22 points or a gain of 2.47%. We look at these sectors' performances on Friday's close. Once again, utilities, because we said 50 again. So all of a sudden utilities says, okay, we'll go with 50, doesn't matter. They pulled back a little bit once we began talking about 25, not 50. But once you say 50, you see utilities and the risk-off rotation still going higher. What is the importance of finding that out? If you're banking on 50, if you're betting on 50, understand that you can go with the risk-on, you can go with the IWM stuff, you can go with the KRE stuff, the regional banks, but you don't have to. You can stick with the utilities, you can stick with the staples, you can stick with the real estate. They're also pricing in 50. And then we see comm services at number 2. This is the comeback of Google. Was the laggard, and now it's finding some bettors who are saying, okay, NVIDIA, I don't like that. Apple, don't like it. Microsoft, we got problems. But then you look at Google, it's already down, the laggard, the bruised. So they bought Google Friday, and we did the same, by the way. Whether that's going to last all the way till Tuesday, who knows? I don't think it's going to last, and this is why you got to be really careful with the twists and turns this upcoming week. Now, we see metals at number 3, and again, one of the top performers for the week. Do metals really care about 25, 50? They don't really care. They care about rate cuts, and that's all what they want. Say rate cuts, and metals will be happy. Steel, chemicals, the agri stuff, the gold miners, all of them did pretty good this week. And the laggards, healthcare, energy, financials, but still closing in the green on Friday. We contrast this with the performance of the week. You see technology at number 1 because the majority of the short covering that took place on Wednesday was on Nvidia and technology companies. So that came at number 1. I think they underperform this week as we see ugly September resuming. We see cyclicals, we see metals at number 2 and 3. So again, some of these sectors, they don't really care about 50. You got to spot them. 25 is good enough. I'd rather be in those than taking the risk and assuming that we're going to get 50 for the good reasons. Not just 50, but for the good reasons. We have 2 outcomes that are bearish versus 1 that is bullish. The laggards, the only sector in the red. Energy again, anytime you introduce a problem such as the information that we got about auto delinquencies, it freaks out and reacts more negatively to the recession news. And it's going to react more positively to the rate cut news. Looking at the breadth on Friday was pretty good because the big caps were okay, didn't go down. They closed flattish, underperforming, but the rest of the market did pretty good. The RSP stuff, the equal weight, even the small caps. So we see the NYSE 86% advancing versus 13% declining. And the Nasdaq with 74% of the flows advancing versus only 24% declining. What really matters to me is the new 52-week highs versus the 52-week lows. The highs 111, lows 39. That tells you right off the gate that the breadth was actually underneath it all, was rotational in nature. The laggards outperforming. Looking at the heat map on Friday again, positive across the map. You only got a disappointment from Adobe. The problem with this software company, it has more exposure to the consumer. And if the consumer is getting squeezed and you're paying Adobe 60, 70, 80 bucks a month to do Photoshop, you're not really using it, that's one corner you can cut and save some money on. Now, in the case of Oracle, you have a B2B company. It's other businesses flush with cash, still spending on Oracle products. So you want to be in the B2B side. I know that I pointed out the IGV, the entire software index, as a better looking chart than chips or the big cap technology stacks. But I think again, it's a picker's market. You have to pick the individual names. The point being software is where the AI mania is migrating to versus the chips. Of course, on Friday, the lagging chips such as Micron was the outperformer, while Nvidia closing flattish. I think the reason here, we've seen a lot of call options, weekly expiration being bought Wednesday, Thursday. So the market maker wanted to close Nvidia flattish and make sure they close the market exercising maximum pain on options bettors in Nvidia. But besides that, folks, we see Pinduoduo, you see the weakness from the Biden administration news. You see that the big caps took the lagging side, Apple, Meta, Amazon in the red. But Google, the laggard, was the outperformer. And of course, Microsoft, it's the closer to software than the rest of the big caps. Then we'll look at Boeing. We got the news from Boeing that we have a strike by the unions. This is the biggest one since 2008. So we see Boeing going down. And of course, in the banks, you see JPMorgan continues to be the laggard because in the case of JPMorgan, it doesn't matter if you're going to cut by 25 or 50. It loses either way. You take the tailwind from the really impressive net interest income that the company enjoyed while rates were higher. You cut the rates, 25, 50, doesn't matter. You take a tailwind out of JPM. But you see the regional banks outperforming, so try to spot these rotations. I don't want to make a big deal about the action on Friday, though, because we will see another twist that could change the map entirely this upcoming week. Yet we contrast Friday's close with the weekly heat map, and we see here right off the gate again, the winners, the big caps, the chips, a lot of short covering. What was the loser in the beginning of the month is the gainer this week. But again, folks, you don't have to take that route. If you're not a fan of the big caps right now or the chips right now, and you see these rebounds, just short covering rallies, look at the stuff that's been performing consistently. Look at the Verizons of the world, up another 8% this week. Dividend paying name. Look at utilities, still outperforming. Look at the good side of real estate. Names like American Tower, PLD, Public Storage. They're still continuing to outperform. You look at the staples, sure. A lot of them were neutral since they were pricing in 50 basis points, like Philip Morris was down for the week. But any pullback in these names, opportunities to buy, because they don't really care in the long run. They don't really care about 50, 25, so long as you're cutting rates. That's what really matters to these names, the dividend-paying stuff. Then you look at consistent performers in the cyclicals. Look at a name like TJ Maxx, been doing good pre the rate cuts and should be doing better after the rate cuts. You look at the home builders, that's thriving on Friday's session because we got 50 basis points priced in. You take that out and we go down to 25. Would that be enough for the home builders to continue to rally? I don't think so. So again, you got to pick here. You look at Blackstone up big for the week. That's a 50 basis points assumption. You get 25, you'll have pullbacks in these names. Looking at the heat map for the ETFs for the week, once again, the TLT is up, meaning that yields are down a tick. But again, the market looked at it as, okay, we're going with the 50 either way. So rates are going down for the right reasons. That's the big assumption. We'll see if we have a validation this week or not. My hunch is no. But right off the gate, you have yields going down for the right reasons. The risk-on stuff will thrive. So you see the IWM, small caps. You see the XRT retail. You see the XHB home builders, the XBI biotech. Even the regional banks did pretty good. But again, even the defensive stuff, the risk-off yield sensitive, such as XLP Staples, XLU Utilities, the IYR Real Estate, the XLV Healthcare, all did pretty good, maybe lagging a little bit, but they still closed positive. Look at gold and silver. The gold miners up over 10% for the week, silver up about 10%, GLD gold up about 3.5%. You think gold really cares about 25 or 50? Gold cares about just give me a rate cut, whatever it is, that it doesn't matter. Even if there is no rate cut, gold is the only reliable resource of safety. So that's one asset that you can buy and not really be worried about the speculation of 25 or 50. Of course, the outperformer for the week, if you look at the SMH chips, if you look at the IWF, large cap growth, the XLK technology, but I think most of these gains are a short covering phenomenon. And if you have a rotational market, or you have any disappointment about the rate cut projection from 50 to 25, I think you see the stuff going down again. Not to mention, of course, the risk of the Japanese yen carry-on trade. If you get a weak retail sales data, for example, the dollar goes down, Japanese yen rallies higher, and then it triggers a point, which we don't know exactly where it is, but it hits one point where we see the margin calls and the big caps showing up again. So I'm not in favor of the big caps, to be honest with you. Not in favor of the small caps. I can rent this stuff from time to time if we have dash for trash, if we have light at the end of the tunnel optimism. But I don't think they're reliable. I think the reliable segments of the market right now is what's been working before the rate cuts and will work better after the rate cuts. And that's the dividend stuff, the value stuff, the risk-off utilities, real estate, staples, and soon enough the commodities, beginning with the metals, and soon enough oil will join too. Speaking of, let's do commodities on Friday. Muted close for crude oil, WTI, and Brent. So did the RBOB, but we see a pullback in natural gas, north of about 2.5%. Now, the problem with nat gas, if we see inflows into oil next week, because we have the rate cuts and we have shorts covering, usually that comes at the expense of natural gas. And I say usually. And this is why if you want to bet on natural gas right now, I think the way I'm doing it is the best way, which is betting on natural gas via the fertilizer stocks. So you look at stuff like Mosaic. The stock was beaten, bruised, but the moment we bought call options on it, it surged by about 5%. And I think if we say rate cuts, it's good for that stuff, for the fertilizers. Maybe natural gas will face a rotational element where flows migrate to WTI or Brent. And this is why I favor the fertilizers as a natural gas play versus natural gas itself. Now, when we look at softs, we see cocoa up, OJ, coffee beginning to find the energy to move higher. Coffee looking for a bullish breakout, so is OJ. Cocoa, I don't think we're going to go back to the highs again, but I think it has more gains to come in this rally that began this week. And if you say rate cuts, again, 25, 50, doesn't matter. Pretty good for this stuff here. And even better for metals, gold, silver, platinum, copper, palladium, all positive on Friday. Also positive for the grains, for the most part, wheat, corn, all rallying higher. The only laggard is soybean oil. And we look at the week, all in all, palladium at number 1, gains of about 20%. Why did that happen? Number 1, rate cut optimism. Good for metals. Number 2, we got the news from Russia. President Putin is at least threatening right now to ban some exports of nickel and lithium, palladium, some of these precious metal exports. And this is why we've seen palladium moving higher. But silver did pretty good too. Rate cut optimism, coffee, platinum, cocoa, oats, wheat, copper, all of these are banking on rate cuts. 50, 25, doesn't really matter. And believe it or not, for the week, the WTI crude oil actually closed positive. And I think this is just the beginning of a comeback in oil once we have the rate cuts. Moving on to the big casino options, what do we have here on Friday's session? The volume remains muted. I don't know where the traders went, but they're concentrated right now in Nvidia, Tesla. You see, of course, MO, Altera Group moving higher, but that's a dividend phenomenon. They're going to pay a dividend, so folks sell calls on it. But the majority of the volume, NVIDIA, Tesla. And of course, Wednesday, Thursday, we've seen folks buying way out of the money calls with weekly expirations on NVIDIA and Tesla. So it's not surprising to me that the market maker closed those pretty much flattish to make sure that all of these folks who were Johnny-come-lately to the trade and they bought the calls out of the money for Friday's expiration lose their bets. Now, if you want to trade options on NVIDIA versus Tesla, I think NVIDIA offers better pricing because the IV rank is much lower at 30% versus Tesla's 72.5% almost. And specifically for betting for a pullback, I think you're better off going with NVIDIA versus Tesla. The pricing is more attractive in NVIDIA right now. Looking at the net flows, not the buy or the sell, the net flows all in all. For the session on Friday, we see bullish bets for Restoration Hardware. We've seen more unusual activities, buying calls on this name before the report came out. We see bullish flows on bonds, on Pinduoduo, MicroStrategy, CrowdStrike, Amazon, MO, Costco, Silver. We see bearish flows on the UNH, United Health, GLD Gold, Meta, Google, EMN. This is for Eastman Chemical. Again, chemicals do pretty good if we have rate cuts, and this was one of the top performers for the week, so perhaps they're selling some puts, booking profits, so it shows here as a bearish flow, but perspective matters. We also see bearish flows in Apple, and that's happening from the buy and the sell side. So believe it or not, Apple remains the weakest link when it comes to the big caps. Now let's cover some of the unusual activities that took place in the options market on Friday, beginning with the bullish ones. And how about EWTX, Edgewise Therapeutics? Of course, this trade was a contributor to why the stock rallied by over 7% on Friday's session, and perhaps they see more gains to come. And here we have a bull call spread. They bought the 22.5 calls and they sold the 35 calls, all for the expiration date October 18th, meaning they see the stock above 22.5 by the expiration date, but not above 35. All in all, spending about a little over $1 million. And then we have CVS, battered, bruised, dash for trash, perhaps. Rate cuts maybe will alleviate some pain in CVS. I'm kind of doubtful. I think that these companies are going out of favor anyways. The blockbuster of our time. And that begins with Walgreens, of course, and then CVS will follow. But here we have a bullish spread, call spread again, buying the 60 calls and selling the 65 calls, so it's a tighter range, all for the expiration date October 18th. And once again, spending about $1 million. What about the bearish trades? Here we have one for SEC Limited. Somebody bought the 75 puts and they sold the 55 puts for the expiration date Jan 17th, spending a little over $6 million. They see C Limited down below 75 by the expiration date, but not below 55. Here we have another one for Coinbase. Somebody bought the 180 calls and they sold the 170. Now, this is called a bear call spread because you're receiving credit. You're selling the 170, you're buying the insurance policy if it goes higher at 180. So your pain is limited to 10 points between 70 to 180 if the stock goes higher. The expiration date, September 20. What are they betting on here? Spending about a little over $1.25 million. They're betting that Coinbase will be below 170 by the expiration date. Here we have a short call. By the way, this contributed to why NVIDIA actually pulled down a little bit in the beginning of the day on Friday. Somebody here closed because I've been watching this trade. It shows up on the short call right now that somebody sold the 130 calls naked, but it was actually a trade that they opened earlier in the week. They just booked the profits from the 130 calls with the expiration date of October 11, netting about $3.5 million. What is the importance of this trade? Number one, for Friday's session, it gave the market maker the signal that we have profit taking by the call holders, the serious ones with longer expirations, not the gamblers with Friday's expiration. And that contributed to the market maker pushing NVIDIA and keeping it suppressed. Number two, the other implication would be why close a bullish trade on NVIDIA at the 130 line with the expiration date of October 11th? You got enough time. If you believe that NVIDIA is going higher, you keep the trade. Why the change of mind? The answer is they don't see NVIDIA above 130 by the expiration date. And that once again suggests that we will perhaps see another twist this week, where the stuff that went higher begins to go down again. Then we have another bearish one. It reads very bearish in the sentiment. For the IYR real estate. Now, the IYR is banking on 50 basis points. It's been rallying because of the 50 basis points. You got to understand that the IYR is heavy with classic real estate companies that pay high dividend, like American Tower, like PLD, like Equinox. A lot of these companies are of high quality. The stuff that we worry about in real estate is the commercial real estate, the offices, the medical properties. Those rally if we have 50 basis points. The big IYR real estate names, they rally based on 25 or 50. But they rallied way too high, as you'll see in the chart in a minute. So to me, that priced in a 50 basis points. If you get 50 or you get 25, you might see sell the news and the IYR pulls back. And I think this is why the trader bought the 86 and the 91 puts for the expiration date of Jan 17th, spending a little over $1.5 million. Here we have another bearish one, this time around for GDX gold miners. They rallied significantly higher all the way from Wednesday to the close of the week. We know why. Pricing in rate cuts. Somebody here says, watch out, maybe we'll get stronger retail data, retail sales that is, and the dollar actually firms up. And this is why they bought the 39 puts, the expiration date October 18th, spending about $3 million. This also makes a good hedge. If you bought the GDX recently, I think hedging all the way to 39 makes sense. If the price goes below 39 for whatever reason, you preserve the right to sell your shares at 39. Then we have a long put for Starbucks. Now, Starbucks did pretty good this week, specifically on Monday. But somebody's fading the rip here. They bought the 95 puts for the expiration date November 15th, spending a little over $1 million. Let's segue to the charts and then wrap it up, folks. We begin with the SPY, an hourly chart. What do we have here? We talked about a bear flag pattern before the beginning of the week. But we also talked about the oversold conditions and the RSI and the MACD indicator and the fact that we might not see the bear flag playing out. But to confirm that the bear flag is not playing out, you gotta have a positive crossing above, not just the average, but the zero line in the MACD indicator. That didn't happen, folks, until Wednesday's session, where we got a confirmation of the MACD cross and we closed above 550. Here's the problem though. Right now, we were oversold last week, now we're overbought. Whether you look at the RSI, the MACD, it's about to shift momentum from bullish to bearish. Now, do you go heavy right off the gate on Monday buying puts, assuming that we're going to flush down? Not really. If we cut below 558.62, better yet, we cut below 550, then we're going to increase the risk that this could be a lower high. At that point, we're going to begin thinking about opening short positions in a bigger way. Because you look at the daily chart, what was the bear to bull confirmation line? It was the daily 50 moving average in blue. If you trade below, if you stay below, downside bets have the better odds that we see more downside to come. If we trade above and we close above the 50 days moving average, it would be considered as a reversal. And upside bets will carry the better odds. So the moment we got that Friday, we adjusted and we said, okay, the downside risk is now limited in the short run. The upside risk is more plentiful. So we're going to adjust our bets based on that. Now, we do have resistance at the lower highs, as you can see in the sloping line here. If you begin to see rejection signs, then that's going to be the permission to close some of your upside bets, because the odds will diminish for these bets. But an official reversal from bullish to bearish will not ensue until we close below the 50 days moving average again. Because if we do that, the likelihood is we might revisit the lows from September. But they're probably not going to hold, and we're going to be down at the lows from August. And if you zoom out a little bit more, you'll notice that the 200 days moving average in orange will not be far away from there. So again, I know that the market action this week might have given the impression to some folks that we're out of the woods, that ugly September is over. But if we stall here, folks, we lose the 50 again, then I think the next stop would be the 200. So keep that in mind. We're not out of the woods. Looking at the SPX, the cash index weekly chart, we talked about no time to die here. And the reason is you got the negative momentum showing up in the MACD and the RSI indicators. And anybody with a technical eye can look at the MACD wave and come up with the conclusion that we're nearing the end of the wave. End of the wave meaning that we go down to the negative and the top is already behind us. That's a huge risk right now. And while the weekly chart closed above the 20 weeks moving average, it's not out of the woods yet. The scenario of an inverse ABC could begin this week with the second half of September after the rate cuts, and we head down all the way to the 50 weeks moving average, which at the time would be close to 5,100. Again, it's the same number that folks keep betting on when they buy these big SPX puts. So keep that in mind. We're not out of the woods yet. Looking at the Qs, the NASDAQ hourly chart, we see a similar phenomenon with the SPY because the majority of the stuff that led the reversal was the big caps, mostly NVIDIA. the highest weighting in the Qs and the SPY. So we see a big rally here in the Qs, but watch the waves in the hourly. We were oversold last week with the close on Friday. With the close of this past Friday, we're overbought. And we see a rolling over in the MACD. It was rolling from bearish to bullish, and now it's rolling from bullish to bearish by the close this Friday. So the risk would be that we pull back. But you got to have confirmations before you bet on it. For example, you got to see a loss. If this is indeed a rising wedge, you got to see a loss of 469 before you get a confirmation that down we go. Looking at the daily chart, what was the bull to bear confirmation line last weekend? It was the 100 days moving average, and that's in the color red. So once we trade below and we stay below, downside bets have the better odds. But once we close above, that's considered a reversal, and upside bets will carry the better odds. And this is all what we've done this week. So again, I don't understand why folks are mad. When I identified the bull to bear lines and confirmation lines clearly, and I told you from the beginning of the week, we're going to abide verbatim to the guideline. Then we got another confirmation in the Qs by closing above the 50 days moving average in blue. So now we have layers of confirmation. If you want to look for a rejection of a sloping line of resistance of a lower high formation, you need a confirmation. And your first confirmation would be losing and closing below the 50 days moving average, and the ultimate confirmation, bearish confirmation that is, will be losing the 100 days moving average in red. Then the downside will carry better odds. And if you lose the 100, then we have to draw another trend line. And we have sort of a triangular consolidation pattern. If you break that pattern, you're going down to the 200 days moving average. In orange this time around would be in or around 443, but again, one step at a time. Looking at the NDX weekly chart, what do we see here? Out of the woods? Absolutely not. Look at the waves. In the MACD, look at the RSI, the vortex indicator. The threat of a bearish confirmation is still here. We just haven't closed below the Fibonacci line of 18,272. I think it will be in or around the 50 weeks moving average in blue that you see at that point. If we lose both, two confirmation lines, I think you play an inverse ABC pattern, and a confirmation of the top in the NDX already behind us. Are we going to head down? We're probably going to settle at the 15,560 line. But again, one step at a time. Confirmations, and you trade accordingly. Right now, we have a bullish confirmation since we closed above the top with the breakdown candle from last week. So you need to see more damage before you switch the bets from the upside to the downside. The IWM small caps. The bearish confirmation would have been the loss and the close below the 100 days moving average in red. So again, betting on downside on the IWM made sense until we closed above the 50 days moving average in blue. Now the upside has better odds. You need to see reversals in the 50, losing the 50 and closing below the 50, and better yet closing below the 100 before you have confirmation that yes, we do have again a sloping line of resistance and we failed at a lower high, and we're heading down again. Looking at the dollar, we have a failure here, the 20 days moving average, but we're not below the bearish indicator, sitting at about 534 basis points. What is the importance of that point, or that level, I should say? If the dollar loses that level, and it's going to happen because either retail sales come out weak, or the Fed does 50 basis points just for fun, you might see the Japanese yen, we're looking at the 4 hours chart right now, you might see the Japanese yen exploding higher. And it might hit the point where we see margin calls once again in the big cap technology stocks here in the US market. Now, if the dollar rallies because retail sales are hot or the Fed does 25, it ain't gonna be good for gold. But right now, to be honest with you, gold doesn't really care about 25 or 50. Of course, 50 will be better because it would devalue the dollar more. But 25 is good enough. And we see right now, anybody who's been waiting, oh, I'm gonna get a pullback or a dip in gold, and then I'm going to enter a long position. Well, so far it didn't happen, so frustration will ensue. A lot of folks will capitulate. You know what? I've been waiting to buy the dip in gold for a while. It didn't happen. I'm just going to buy it right here. And it might be the right call, by the way, because you look at the weekly chart for gold. It reminds me with the run that we got back in the year 2020. It almost looks identical, where we see a big breakout. So folks who say, oh, it's overbought, not going to enter it right now, it just keeps going and going before it pulls back. So that's the psychology in gold right now, and it's positive that we see capitulation of folks on the sidelines hopping in. Now, you look at the GDX daily chart for gold miners. It remains in the positive trend of higher lows and higher highs, and it might continue to move higher at this point if the dollar continues to go down. But as I said before, the gold miners make a better trade when gold rallies, But in the long term, as an investor, you're better off owning the commodity gold or the GLD, the ETF. Another option would be physical gold. But the gold miners, they overreact to the upside and the downside, so they can make a better hedging instrument. If you own the GLD or you own physical gold, you can buy puts in the GLD from time to time when you anticipate the dollar going higher. You can also use the SLV silver as an instrument to hedge your gold position. Now, the SLV will rally higher if we have 50 basis points. It needs the 50 more than gold. And right now, it's the top of the Bollinger Bands. There is risk that the Federal Reserve, J. Powell, will do 25 basis points, not 50. So for me, this week, as somebody who's long gold, I'm going to use SLV puts as my way to hedge against my gold position. What about crude oil? What do we see here in the daily chart? Nice rebounds, but is it enough? Because right now, from a technical perspective alone, can we flush down an inverse ABC pattern if we see a failure at this point? Highly likely. And this is why I said throughout the week, nibble on positions in oil. But it's not going to be the all clear for crude oil until we have the cuts out of the way. And maybe it's going to happen this week. We see a crossing and a closing above the 20 days moving average in white. And you see the confirmation in the MACD indicator. And then oil will be out of the woods and we'll see a big short covering rally. What's important in the bond market? When we look at the 2 to 10 year spread, aka the yield curve, that's your leading indicator. If you see a rebound moving higher, that's bullish for the market. If you see us going down, that's your leading indicator that be careful, downside is about to come back again. Look at the contrast. In candlesticks, you got the 2 versus 10. Heading down, by the way. Friday's session, the ratio was down, but the NDX in white moving higher. Is the ratio between the 2 and the 10 telling us in advance that we have a bearish reversal coming in the NDX? I think as we stand right now, the answer is yes. And if that is the case, what do we do with the home builders, XHB? Because initially, we got the news that we're going to do 25, not 50. We've seen the bear flag in the XHB playing out, and it was a big flush down in the home builders. Then we began talking about, no, it's going to be 50. And we've seen the XHB moving higher. That's your indication that the XHB requires 50. And if you're betting on 25, not 50, you probably think the XHB is going down again. It's at the upper Bollinger Bands, facing resistance, and it might go down if we have 25, not 50, or even 50. But for the wrong reason. Keep that in mind. They're really fragile. The regional banks, the XHB home builders, the IWM small caps, really fragile. They require perfection to perform. Looking at the IYR, here it is again, weekly chart. It's been the winner so far. When you say rate cuts, dividend-paying stuff going higher, and you're relieving some of the risk in the commercial real estate, all good for the IYR. But is it way too hot right now? Yes, it is. You can see it in the RSI and the MACD. Can it rally higher? Yes, it can, all the way to the Fibonacci of 107.36. But there is high risk that if we don't get the 50 basis points rate cut, or if we have them for the wrong reasons, that we could see some outflows out of real estate. Now look at the KRE regional banks. It's been under the 50 days moving average in blue all the way till Friday, where we began pricing in 50. So the KRE loves 50, not 25. If we're not going to get the 50, KRE will go down. What about the volatility index? We're looking at the VIX 2 hours chart this time around. I'm in the camp that we're just reloading the gun here for another shoot higher in the VIX. And if you look at the seasonality of September, the second half, and you look at the 2 hours chart, just look at the MACD indicator. It's been under negative/bearish momentum, but it's readying for that big move higher. I think that's going to happen because the market will be upset with a big assumption of 50 basis points, but either it's not going to happen or it's going to happen for the wrong reasons. And we see the VIX going higher, perhaps a falling wedge, but your confirmation, bull to bear advantage line, 20. You're not going to feel comfortable as a bear shorting the market until the VIX trades above 20. Now, from the perspective of the weekly chart, this is really important. If we're above the 20 weeks moving average, you gotta assume that we have upside coming from the VIX. If we close below the 20 weeks moving average, okay, we're out of the woods. Right now, despite the pullback in the VIX, we're within the body of the bullish candle from last week, or we're above the 20 weeks moving average. I think anybody rational right now cannot dismiss the risk of the VIX flaring up again. Big Kahuna Apple, what do we see here? Weakest of the bunch when it comes to the big caps, and this is why we're keeping the puts only in Apple. We closed all of them against the big caps and the chips. We only left Apple going on. It is below the 50 days moving average. And if we see the big caps falling out of favor again, then I think we see this as a bear flag pattern and Apple heads down. Furthermore, look at the weekly chart for the big kahuna. It looks as a lower high. It looks as the momentum in the MACD is about to shift from bullish to bearish. And we might see an inverse ABC play out. So I'm going to stick to the bearish bets right now, carrying the better odds against the big kahuna versus the upside bets. Now, if we close above the 50 days moving average, things could change. Looking at the Stagflation Tesla daily chart, above or below the 50? It's above. So the upside bets carry better odds. The problem is we haven't closed above the top of the bearish engulfing candle from the week before, so I don't have a confirmation yet. My confirmation in reality, if we shift to the weekly chart, is the 200 weeks moving average in orange. It was the point of rejection last week, and unless we close above, keyword close above, I ain't buying calls in Tesla. I understand that there is a argument here that maybe we're doing a cup and handle pattern. Got it. We got another pump of the robo-taxis coming in October. Got it. Before you suck me in, though, give me a close above the 200 weeks moving average, and then I'm in. Otherwise, I think that the downside risk cannot be ignored in the souffle. Looking at NVIDIA, the bull-to-bear advantage line was the 100 days moving average. That's in red. The moment we closed above on Wednesday, upside bets carry better odds than downside. And we got another confirmation closing above the 50. Right now, upside bets carry the better odds, unless what? Unless you lose the 50. And that's not going to be enough. The second confirmation will be enough, which is losing the 100 days moving average. That's going to give you a confirmation for a lower high. If we look at the hourly chart for NVIDIA, my line, it's close enough to the 100 days moving average, at least was 110.90. If NVIDIA holds, recover, and holds, it is bullish, not bearish. If we go below, then I think that the bearish outlook gains more momentum and better odds. Lastly, tulips, Bitcoin, weekly chart. I'm only looking for a bearish trade here if we take the 50 weeks moving average, not days this time around, weeks moving average out, meaning closing below the 50 for the week. If that happens, I'll be shorting MSTR, MicroStrategy, which had a pretty good week this week because they increased their bets on Bitcoin. But there is a flip side to that coin. If Bitcoin loses the 50 weeks moving average and heads in a downtrend, then what do you think will happen to MicroStrategy? It's even at more risk, but you gotta get the confirmation first. With that out of the way, moving on to the conclusion of this video, what do we have on the economic calendar this week? We have plenty. If you thought last week was important, this week is even more important. We begin Monday, September 16th. Not a lot. We have the Empire State Manufacturing Survey. They're probably not going to be a surprise in this one. We know that manufacturing is weak. Then Tuesday, September 17th. Critical day because we got retail sales. And retail sales will be the last piece of the puzzle that we need before the FOMC. Now also on Tuesday, September 17th, we're going to get industrial production, capacity utilization, business inventories, on top of the Home Builders Confidence Index. All important data, but not as important as retail sales. And here it is, the big day, Wednesday, September 18th. We're going to get housing starts, building permits, but most importantly, we're going to get the decision from the FOMC and the conference speech by Chairman Powell. And lastly, Thursday, September 19th, because Friday the 20th, we got nothing, baby. But the 19th, we got initial jobless claims. We got the Philly Fed Manufacturing Survey. On top of existing home sales, we finish the macroeconomics data with U.S. leading economic indicators. All important. But of course, retail sales, the FOMC, that's what's going to dictate what happens next in the market. Whether ugly September comes back again, or do we get out of the woods? But remember, in our discussion in the beginning of the show, 2 outcomes from the week suggest that we're not out of the woods and we meet ugly September again. Only one scenario where we get out of the woods. We'll see what happens, folks. But unfortunately, we have to conclude right here. Long show, but lots of information we covered here. So if you enjoyed the show and you found the information and the presentation helpful for you, please return the favor by pressing the like button, leaving us a nice comment, and better yet, joining us as a member, either here on YouTube or better yet in Patreon so you're not paying Google. All of the links in the description. You're going to access the daily show and you're going to access bonus videos if you become a member. But with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
There are a lot of Benjamins to be made right now with the biotech stuff. I don't have to tell you that. How's your portfolio?
I'd say strong to quite strong.
Yeah. You gotta strike while the iron's hot.